So I've always heard and mostly followed that you need to keep a reserve mix of cash and bonds in your stock portfolio. This cash just sits there and doesn't do anything for you because bond rates are so low right now. And I felt that there has to be something that I can do to get a better return. Now, I debated sharing this for a couple reasons. Number one, it's a new strategy for me and it is not as time tested as my typical buy and hold strategy. Number two, it's very risky and it is typically not something that you'd want to do with reserve cash. It's very easy to lose all of your money if you get greedy with the strategy. But ultimately, I decided to share it because the returns were way too good, and I think I have a strategy that I think will reduce the risk and still get better returns than bonds. So in this video, I'm going to show you the options strategy that I stumbled into that got me way better returns than I expected, and also how you can follow it yourself to get the same gains. Typically, I haven't been somebody to carry a lot of extra cash in my stock portfolio, but after the March and April crash followed by the rebound, I ended up selling some stocks that I felt were a little riskier than I'd like to hold. I thought there was enough risk with how bad the economics looked that we could see a second sustained sell-off. So I had about $1,700 in cash, and I thought a great idea would be to take it and put it into a medium-term bond index fund. It'd pay me a safe dividend every single month, and if the market did come down, I'd be ready to take advantage. Well, after holding this for about a month, they paid me a dividend, a whopping $1. For those doing the math at home, that is a 0.05% 1 month return, or for a full year, 0.7% return. So this really didn't sit well with me. And I thought about what if I took some of that money, maybe $200 worth, and I ended up selling an option. I could net $50 and I'd end up with about 2 years of returns in a week. So I ended up giving it a shot and it completely worked out. So basically what I'm doing is I'm selling call or put credit spreads on stocks that I think have a really safe floor or ceiling over the next week or two. Now, if this is total Swahili for you, let me explain options. I promise it is really not that complicated. Options are basically buying a contract that gives you the right to buy or sell a stock at a certain price on a certain date. Now, I don't want to make this really confusing, so if you do want to learn more about this, I'd recommend checking out Investopedia's website and reading a little bit more about how they actually work. There's a link in the description with some resources if you're interested. Also, while you're down there, don't forget to hit the like and thumbs up button if you like this kind of content. Hang on, this is getting a little bit dark here. So now there's two types of options that you can buy or sell. There's calls and there's puts. Calls mean that you have the option to buy 100 shares of a stock at a certain price on a certain date. Puts mean you have the option to sell a certain stock at a certain price on a certain date. Now, if you only remember one thing, remember this. When you buy a call, you want the price to go above a certain price. When you buy a put, you want the price to go below a certain price. This price is called the strike price. That's basically the target that you want to be above or below. Now, just one more time so that everybody remembers. When you buy a call, you want the price to go above the strike price. When you buy a put, you want the price to go below the strike price. Now, obviously, nobody would give these contracts out for free, so there's obviously a cost with buying an option. And when you buy an option, you're always buying the right to buy or sell 100 shares. So that means when the option costs 25 cents, it actually means it costs $25. Now this means though, to break even, you need the stock to move an extra 25 cents away from the strike price to make your money. So let's say, for example, on stock ABC, you buy a call option for 30 cents at a strike price of $95 set to expire on September 4th. If on September 4th, the stock is at $105, you get to buy 100 shares of that for $95 that are now worth $105, netting you $1,000, but still costing you $30. So the end result is a $970 gain. In a different example, let's say instead on September 4th, the shares are worth $90. That means that the option expires worthless and you lose the $30 that you spent on the option. Now, one other term to know is if the option is on the correct side of the strike price, that's called in the money. It basically just means that if expiration date was today, you'd make money. So now the cool part about options is not only can you buy them, you can actually sell them. This means that somebody pays you a credit, and if the option expires worthless or out of the money, you get to keep the credit. Now, if the option expires in the money, you owe them the costs of buying or selling 100 shares of whatever stock it is at that set date. So Here's what I've been doing to make money with options. A lot of options contracts expire totally worthless. So what I'm doing is I'm looking to sell options that have a low chance of actually occurring. Then to help cover potential losses, I buy a second option slightly farther out of the money as insurance. This is called a credit spread. It just means that somebody's paying me for an option and I'm paying somebody else slightly less for an option that has an even lower chance of occurring. So this does cap the potential gains, but it also puts a significant cap on the potential losses that I could end up paying. So the first thing I do is I start with companies that I know really well. I have a really strong feeling for the valuation, the sentiment, and all of the news going on with that stock at the time. I consider the price movements, how likely that stock is to break up or break down over a certain time period, and I also buy a lot of different options so I'm not putting all of my eggs in one basket. An individual put credit spread has a high likelihood of return, but with that return, you get a generally lower payout compared to other options, and the possible losses you can take are much higher than other options. So to have success, I have to be very active to prevent potential losses. When things start to look bad, I just get out. I don't worry about what if it ends up being right and I would have made money if I stayed in. I want to prevent losing money more than anything else. It's very important to not have the fear of missing out with selling credit spreads, because if you end up holding on to something, the amount that you can lose can quickly wipe out your gains. If you're one of those people who really struggles with the fear of missing out, I would not recommend the strategy for you at all. So here's the strategy that I've come up with to help mitigate some of the risks that you can run into with selling credit spreads. Let's pretend I have a budget of $1,000. I would use $300 or 30% to sell credit spreads and then keep $700 or 70% in reserve. This way, if the stock takes an unexpected loss or gain and you lose money, which really shouldn't happen too often, you're only out 30% of your budget. If you're making smart decisions, you should be able to quickly build back any potential losses, but this will only work if you aren't risking too much of your budget. If you risk too much and lose it all, you are completely out of luck. Now, it's very important to not get greedy and risk it all in one specific stock or one specific industry. Make sure you're choosing both put and call credit spreads, so if all the stocks go up or all the stocks go down, you don't get completely wiped out. You can also choose a wide variety of long and short expiration dates. The law of large numbers in statistics and probability says that as a sample size grows, its mean gets closer to the average of the whole population, meaning that the larger the number of credit spreads that you sell, the more likely they are to pay off. Okay guys, I hope you liked the video. Comment below if there's any option strategies you think that I should know about. Don't forget to subscribe if you thought this video was helpful and you want to see more videos like this. Thanks for watching.